Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome everyone, this is Steve Meizinger, your host for today's ISE webinar. Today I'll also be the presenter though. So I'll be talking about FX options volatility. I'll try to explain it as best that I can. Volatility is a very, very interesting subject. That's why we thought that it might make sense to do this sort of refresher on volatility. This is the fifth presentation I've done as far as the back to basics. I hope you've enjoyed that. We had a great presentation just the other day. John Netto, he did a fabulous job talking about what's going on in Europe and really talking about some potential trades that might work out. They might not work out. Of course, you never know, and that's what trading's all about, thinking about risk, reward, and probability. So today I'll be talking about volatility. I hope you enjoyed the presentation. Just a quick word. We at the ISE are very excited. We're going to start trading the FX options on April 30th at 7:30 Eastern Time, so we're going to actually start 2 hours earlier. Hopefully this gives all of us, traders, the ability to trade, finding opportunities, 2 hours early. So you don't have to, you're not forced to trade 2 hours early. You should never trade unless you think that there's an opportunity for you. But to check it out, and that'll start on April 30th. It'll be in all the pairs. So please check it out, April 30th, just a couple weeks away. If you want to learn more about options, the first thing, of course, the first site is fxoptions.com. We offer tremendous free tools, the educational webinars that we offer. We have a trader forum. We've had trading contests. Now we're going to offer some more tools such as, we have an options calculator, and soon we're going to have an options skew chart, which I think is fabulous, and I'll show you that a little bit later today. Also check out optionseducation.org. Great website. Everything there is free. So I'd urge you to go to optionseducation.org. Anything that I talk about today, I'm not giving any recommendations. Taxes, margin, or commission are not included, so you should definitely consider those prior to any trade. And risk reward, very, very important. Thinking about the risk of the trade, so not only the reward but the risk. What if you're wrong? Can you afford to lose this capital? Because it's going to be risk capital that you're investing unless you're hedging. So you want to think about that. So let's get to the refresher part of this presentation. FX calls are the right to own the exchange rate. The puts are the right to sell it exchange rate value. So when I'm thinking about these option strategies, many times I get questions. They say, Steve, what am I looking at here? Should I be looking at calls or looking at puts if I'm bullish? And the way I like to keep it simple is you look at the pair. We have pairs that are the U.S. dollar base. We also have pairs that are U.S. dollar quote. U.S. dollar base means it's in the numerator. U.S. dollar quote, it means it's in the denominator. I like to look at the base currency, meaning that if the dollar is the base currency, it's in the numerator, then you're looking at calls. So you're looking at that base currency and saying, what am I on that base currency? If I'm bullish, I might be buying calls. If I'm bearish, I might be buying puts. That's just as simple as it can be. So just think in terms of the base currency. If you're bearish on the base, as I said, you might be buying puts or selling calls. Tons of option strategies are available. I'm not going to go through every one of these strategies, but you need to think about volatility, and we'll talk about that over the next hour. Why volatility is important. Because once you decide your view of volatility, then and only then will you make the decision of which option strategy you might implement. So let me go through the features of the ISE FX options, well, they're options on the exchange rate. We have 50-cent strike prices. Premiums quoted in U.S. dollars. We have European exercise, cash settlement, noon settlement on option Friday at the WM Reuters rate, and they're available in a conventional brokerage account. We have market makers that quote these, and the trading hours are soon to be 7:30 in the morning. That's going to start on April 30th. So we are now moving the time, 7:30 Eastern Time. That will move from the 9:30 start that we now actually have, and we're going to move to 7:30, so 2 more hours. So that might make a difference for some of us. Spot currency conventions. If you look at the spot market, and many of you probably know the spot market or at least have taken a quick look at it, the Aussie dollar versus the U.S. dollar, British pound versus the U.S. dollar. So I'm not going to go through every one of these, but we have a corresponding ISE symbol. So AUM would be the Aussie. GBP, how convenient for the British pound. Canadian dollar, CDD. So here you'll notice that the U.S. dollar is in the base, and here it's in the quote. And that's why you'll need to think about calls or puts. So if I was bullish on the Aussie, I might be looking at buying calls on AUM or selling puts if I'm trading AUM. Now, there is another vehicle out there. It's AUX, and AUX is the U.S. dollar currency pair value where the U.S. dollar is in the numerator. It's the base currency, so you'd be doing the reverse. So just look at it from the base currency. What are you on the base? So if you're trading the yuck, I'm going to look at the dollar and say, am I bullish on the dollar versus the yen? If that's the case, I'm going to be buying calls. If I'm bearish on the dollar, that means I'm going to be bullish on the yen. I'd be buying puts. I hope that's clear. So here's the U.S. dollar base. So again, bullish on the base. If I'm bullish on the base, I might be buying calls or selling puts. Oops. Buying calls or selling puts. Now, we just added about 6-7 months ago, we added the U.S. dollar quote currency conventions because that's the way they're traded in the spot market. And I just mentioned the AUM. That's the Aussie over the U.S. So if I'm bullish on the AUM, and the AUM is trading almost at a new high here, if I believe that trend was going to continue, I might want to buy a call. So that's very, very important to think in those terms. And we also have the British pound, the euro, and the New Zealand dollar. So all strategies work. They just don't work all the time. And when you're trading any kind of option, you're looking at how far, how fast. How far and how fast. And what premium am I paying? So how far, what timing, how fast will it happen? You know, how far is magnitude, I should say. How fast is timing? And then, you know, as far as I need to think about what the volatility is. What am I paying versus how far do I think it's going to move? If I'm looking at a 100 call on the U.S. dollar Canadian, and maybe I'm looking for a 3-month time horizon, and I think that the U.S. dollar Canadian is locked in a range from 98 to 102, well, it wouldn't make any sense for me to buy this 100 call for 3. Now, you might think, well, why don't I just sell all these options? Well, you need to think about risk-reward. So what you could do is sell a credit spread. You could do something like that. Options give you the ability to control the exchange rate for a certain period of time, call it the expiration, at a certain price, a strike price. So the buyers are going to pay a premium to the seller. The seller receives the obligation to either sell or buy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.